All right, Wes, you should be good to go.
All right. Sounds good. Thank you. All right, everybody. It's 2 o'clock. We'll go ahead and get started. Thank you so much for joining. If you are new here, my name is Wes Gottesman. I am a market advisor with TradeZing. And twice a month, we do a webinar, various different topics. This one happens to be transferring wealth through the use of life insurance. Now, I'm not going to get into the nitty-gritty details of each individual type of life insurance. I will go over them briefly, but this will be an overview using the basic information that I'm going to give you about each type of life insurance. You'll be able to discern the conversation in regards to transferring the wealth from different type or transferring the wealth via life insurance policies. So without further ado, we will get started. And also, Happy New Year. It's the first webinar in the start of the new year. We do have another one in a few weeks. We'll make sure to make some posts about that. But so starting out, I'm sure many of you, if you're younger, older, doesn't matter. You've heard of life insurance. You've heard that so-and-so has purchased life insurance and this person sells life insurance. I'm sure of it. It can be a buzzword and it can be rather confusing if you don't have the knowledge about it. This is not something that they teach us in school, in college, for the most part. So there's a variety of resources that I recommend reading if you want to learn more about it on your own that I will mention at the end of the webinar. So the first things first is, why would someone buy life insurance? Well, life insurance is simply to protect one's family from an early death or death in general. The opposite of life insurance would be an annuity. So an annuity is to protect from outliving your income. So it's a guaranteed income for many years to come. That's also something that I will go over in the more detailed life insurance webinar. So an annuity is sold through a life insurance company. So that's also something to keep in mind. And you can also exchange life insurance for an annuity. So you already have a policy, you don't want it anymore, you can do what's called a 1035 exchange. And if you're in real estate, you know what a 1031 exchange is to defer taxes on the sale of one property and keep deferring. A 1035 exchange, if you have a life insurance policy and you want to switch it to a different life insurance policy, you would do a 1035 exchange. If you want to go from a life insurance policy to an annuity, 1035 exchange. You cannot 1035 an annuity to life insurance. So just keep that in mind. So I'm going to go over a broad spectrum of the types of life insurance that are available real quick. So the first one, and if you're younger, I'm sure you've heard of this, or somebody at Northwestern Mutual has pitched you on this one, but term life insurance. So term is probably the most useful type of life insurance for most people because it's affordable. It only lasts for as long as you designate the term to be. So whether it be a 20, 30-year term life insurance policy. And it doesn't come with many tax rules or restrictions. So term life is usually the easiest and the cheapest way to provide a financial safety net for your family. But it can also be used to cover business partner, even key executives, whose death would cause significant financial loss to the company that they work for. So to put it plainly, term life is death benefit only. That is the only reason why you would purchase it. And you can place a return of premium rider on the policy, which a good friend of mine, Brandon, he sells life insurance. He was talking to me about return of premium. That's where I learned about it, actually. I didn't know that was a thing until he told me. But so you would be able to have most of the premiums paid back to you at the end of the term. And then the next one, so term, the next one would be whole life. So whole life is the most common type of permanent, keyword permanent life insurance. Keep that in mind, permanent life insurance in our discussion in a few minutes. Uh, it's the most common type because of its simplicity and lifelong duration. So its cash value is an investment like tax deferred savings account, earns interest at a tax rate set by the insurer. A fixed rate set by the insurer. It's Friday, 2 p.m. Apologies. Your premiums also remain the same for the lifetime of the policy, which is important. You don't want to have premiums that are constantly fluctuating. I mean, some people do, some people don't. So how it works is whole life insurance has a guaranteed death benefit and a cash value that earns interest over time. A portion of your premium goes towards the cost of maintaining the life insurance policy, and the rest goes toward the cash value account. So once you've accumulated enough cash value, you can borrow or withdraw money from it. Also keep that statement in mind for the discussion in a few minutes. The next one is universal life insurance. So when I was studying for the Series 7 years ago, I used to have a little acronym for all the different types of life insurance policies. So universal life is a flexible, permanent life insurance policy that also builds cash value, just like whole life. So what makes it unique is that it lets you decrease or increase how much you pay towards your monthly or annual premiums over time. Flexible. If you decrease how much you spend on premiums, the difference is withdrawn from your policy's cash value. Universal life policy would be a good fit if you have a higher budget and looking for some sort of flexibility in your life insurance policies. They can be even more expensive and complicated than a standard whole life policy, especially as you get older and your premiums can increase. So, it allows you to adjust your premiums and death benefit depending on your needs. If after some time you decide to stop paying or lower your monthly premiums, you can use your cash value to cover your premiums. So that's a nice feature. The next one, variable life insurance. It's another type of permanent policy. The only one that's not permanent is term, just to keep that in mind. Okay. So it's another type of permanent that allows you to invest the money from your cash value into various funds offered by the insurance company. More often than not, it's mutual funds, and you have the autonomy to go in and choose how you want to invest it, which is pretty sweet. So it comes with a guaranteed minimum death benefit. The cash value amount isn't guaranteed and will depend on the market conditions since it is invested. And you can invest it as conservatively or as aggressively as you'd like. You may earn more interest than you would on a whole life policy, but you can also lose money if the funds underperform, which is likelihood. So it provides the opportunity to invest the cash in various funds offered by your insurance company, including mutual funds. It will reflect broader market trends if you invest it that way. And the last one, it's important. It's very important. It's called final expense insurance. It's also known as burial insurance. It's a type of life insurance designed to pay a small death benefit to your family to help cover the end of life expenses like funeral, medical bills. Tombstones and coffins are very expensive. Unlike traditional life insurance, which is meant to replace decades worth of income, burial insurance is usually suited to older adults who want a smaller policy just to cover the funeral costs. So now getting into the wealth building of it, we're going to start out with how you can use life insurance to build wealth, and then we will talk about how you can transfer wealth. Okay, so like I would mention before, term life insurance can be used to build wealth across generations by providing a payout to your surviving loved ones. Okay, the death benefit can be used to pay estate tax as well as preserve remaining assets. In that sense, term life insurance is more designed to protect wealth rather than to build it. Conversely, permanent life insurance, I said keyword permanent, can be used to complement an investment strategy since you can access the cash value from your policy while you're alive, right? You can use your permanent life insurance policy almost as a bank. Instead of paying the bank back, you can pay yourself back. So if properly used, the proceeds from whichever life insurance policy that you want can be accessed as a tax-free loan, and the interest rates are guaranteed. So, just keep in mind. So let's say it's you borrowed $1 million off the $2 million policy. Any outstanding loans are going to be subtracted from the death benefit, if you die before paying it back. So on a $2 million loan, you owe $1 million, you're going to get $1 million worth of death benefit. Pretty straightforward. So now going into transferring the wealth, okay? So this is going to have a little bit more to do with gift tax, estate tax planning, and trusts, okay? This might be a little bit of gibberish to some of you. Feel free to ask questions anytime. So gift and estate tax planning are often a primary focus for high net worth individuals. Okay, the 2024 law allowed each person to transfer up to 13,610,000 to their children or grandchildren without paying any gift or estate tax. 2023, that number was 12,900,000. I believe it was 12,900,000. The exemption, however, is scheduled to be cut in January 1st of 2026, depending on who is elected to be in office. So we shall see. But the 2024 law, each person can transfer up to 13,610,000. This was 13.61 million. But hopefully it doesn't go down. But with the current flat tax rate of 40% maximum, which can be anywhere from 18 to 40%, depending on your income, applied to all assets in excess of that gift tax exemption amount. Gift tax planning is not only important to individuals who exceed that exemption amount, but also to those who are likely to exceed the future exemption amount based on the growth of their assets and the potential reduction of the exemption in the future, 2026. So for individuals who are interested in maximizing the amount of wealth that can be transferred to the next generation, life insurance is often a perfect asset to do so. And that's because of the leverage you have from making a gift of the premiums, but having your heirs receive a much larger death benefit amount. So I'll explain what that means in a minute. But in addition, life insurance death benefits are generally income tax free, allowing the much larger death benefit to be received without being reduced by income taxes. However, in order to avoid having the death benefit itself subjected to the estate tax, the insured cannot be the owner of the policy. That's the big thing right there. So the insured cannot be the owner of the policy. So most often we'll use an irrevocable life insurance trust as the owner to manage the policy during the insurance lifetime, manage and distribute the proceeds following the insured's death. Okay. Now, on the topic of gift taxes, a properly drafted irrevocable, some people say irrevocable, doesn't really matter, irrevocable life insurance trust, or I should have mentioned it's also referred to as an ILIT, I-L-I-T, it's an acronym. But a properly drafted ILIT will minimize the use of estate and gift tax exemption by allowing some or all of the contributions to the trust to qualify for the gift tax annual exclusion, under which, as of 2023, each person, and it hasn't changed for 2024, each person can give up to $17,000 per year to as many people as they'd like before having to use gift and estate tax exemption for anything in excess of that amount. So something difficult that one may encounter when making gifts in trust rather than gifts directly to the beneficiaries of that trust and still qualify for the annual exclusion is that the annual exclusion is only available for gifts of a present interest, they always try to nickel and dime you with certain rules. So the annual exclusion is only available for gifts of a present interest, where the beneficiary or the recipient, it doesn't matter which one, of the gift can benefit immediately rather than at some point in the future. So how do we get around that? In order to convert what is usually a future interest into a present interest, the beneficiaries of the trust need to be given a limited withdrawal right, typically a 30-day window within which they withdraw whatever property was contributed to in the trust. And only if they fail to exercise their withdrawal right does the property remain in the trust and get administered under the terms of the trust agreement. I know that sounds absolutely crazy to people who understand that, and to people who don't understand that. It's, there's trust, there's a lot of buzzwords there. We don't have enough time today, but I will absolutely go over trusts and all that good stuff as well. So, like I was saying before, these limited withdrawal rights are usually referred to as crummy withdrawal powers, if someone refers it to that way, which are named that way because the last name of the first person to utilize this method of obtaining the annual exclusion for gifts made in trust was last name Crummy. So they call it the crummy withdrawal powers, CWP. A lot of people always ask, how irrevocable is an irrevocable trust? What the terms of the irrevocable, what the term means is that, I'm sorry, I'm just getting myself all jumbled there. So the term irrevocable means that the terms of the trust agreement itself generally cannot be changed by the creator of the trust, who is called the grantor. Okay, once these powers and once these rules are set in stone in an irrevocable trust, they can't be moved. They can't be changed. But what a lot of people do not recognize, though, is that there's a lot of flexibility that can be built into the terms of the trust agreement itself so that the trust can properly respond to changes in circumstances in the future. The trustee can be given a lot of discretion over when to distribute the assets, the beneficiaries of, to even how to allocate the assets among multiple beneficiaries. The grantor or spouse can be included as a discretionary beneficiary of the trust, so that if the spouse needs the assets, those assets can be available and distributed. So when planning to transfer assets using an ILIT, irrevocable life insurance trust, make sure that it's your trust. You can write it to say whatever you want, and make sure that you have, or whoever you're working with or whoever you're advising, puts in that level of flexibility into the trust documents. It's very important. But so what I was saying before is that if the spouse needs the assets, if the spouse does not need the assets, they can still be protected from estate tax. The grantor can be given the ability to remove and replace the trustee at some point in the future if the trustee is not operating the trust in a manner that it was intended. So, there's many different rules that can be written into the trust. The takeaway from all this is that high net worth individuals should use life insurance to leverage their gift tax exemptions into the much higher death benefits that can be received from a life insurance policy, and should also considering using an irrevocable life insurance trust to own that policy in order to keep the death benefit outside of their taxable estate. So I know that was a lot of information, and as always, you can reach me on Instagram at the Wes Gottesman. You can reach me on TradeZing at Wes anytime if you have any questions about that. If you did have any questions and you wrote them down, feel free to ask me anytime. I will definitely be doing a webinar on doing different kinds of trusts and what you can put into a trust, what you can't put into a trust, all that good stuff. It's something that we deal with on a day-to-day basis. A situation with a irrevocable life insurance trust came up a couple weeks ago, so that's why I thought it would be a good idea, just because I think it's interesting for people to know. It's important for people to know what they can do with their money and how they can leverage life insurance and how they can leave an unbelievable amount to generations to come. So it's very important. So join us next time for another webinar. Stay tuned for the date, and then also feel free to hop on the TradeZing audio room Monday through Friday, 4 p.m. Eastern Standard Time after the market closes. We talk about afternoon commentary from the day before, what happened during the day, and any notable news, and also some good picks. So have a great rest of your day. Happy Friday, and have a great weekend, everybody. Bye-bye.